Welcome to Subramani. I keep saying be prepared for a downturn as if the downturn is going to happen tomorrow. I do not know when the downturn is going to happen, but I know one thing. Every bull market ends badly, right? So if there is a bull market, one day it will be bad. So we do not know which day it will be bad. Sorry. But videos like this don't get enough visibility as if I had said best 5 stocks to buy, and there would be 5,000 people watching it in the first day itself, and I'll end up with 50,000 views over a period of time. But videos like saying be prepared for the downturn, people don't like to do that. So if you were to have a downturn, what would you do? Okay, first problem is right now interest rates are low, so people are looking for better returns in equity or in lower quality debt or even in lower quality equity, because higher quality equity is expensive. Mistake number 1 in a bull market: don't lower the quality of your portfolio. An LMW at 9,000 rupees may be still cheaper than some other share at 9 rupees, which will go from 9 to 0. An LMW will also fall, but you will not lose your capital. I'm not recommending it, I'm just saying a high price script. So LMW was the first thing which came to my mind. It could have been Apollo Hospital, it could have been MRF, it could be anything. Any expensive share today looks like, oh my god, it's so expensive, let me buy something cheaper. Don't make that mistake. When the market comes down, the penny stocks will just vanish. You will not know what hit you, right? So it's easy for you to hear me saying stay the course, stick to your asset allocation, equities are for the long run. All this sounds fantastic. Over a glass of whiskey in a bull market is at 54,000 Sensex, great things to talk. Question is, how will you react when the market comes down to 38,000? It's like, going to one of those jungles, knowing fully well that you will never get off from your jeep. But if a tiger came to your jeep and came very close and within say 5 feet, or what do? The law says you have to be at least 20 feet away, which means it's not the tiger's fault, it is your jeep's fault. It is staying in the wrong place. But having done that, the tiger, if it is 10 feet away from your jeep, it is one leap away from you. It can do whatever it wants. It will not, 99%, the tiger is not likely to do anything foolish, but we are. So at that stage, you cannot even breathe because the tiger can hear you very well. The tiger can hear you 16 times better than you can hear the tiger, 16. So the breaking of a twig, the picking up of a bottle, the wearing a cap, every move of yours, the tiger can keenly hear. It may not be able to smell you, but it will be able to hear you, right? So if you are that close to a tiger, and we have been that close to a tiger sitting inside a jeep, if you are tempted to touch the tiger, not that you can, you're at least 10 feet away, that is the stupidest thing you can do. What is the most important thing you have to do when you are so close to a tiger is just sit tight. It has happened to me with elephants, it has happened to me with the tiger, right? Both cases, you have to do nothing, you have to just freeze. You have to wait for the animal to move away, because if an elephant, I think the most dangerous animal in the wild is an elephant, because it can outrun you and it can throw your jeep away. A tiger attacking a jeep, probability is very less, but an elephant looks at a jeep like a toy and it can just pick up the jeep and hurl it away. Has it ever happened? No, I have not heard of such stories also, but yes, an elephant is scary. So what should you do when the markets go down? I can say just sit tight, do nothing. Okay, so what all should you do for that? First, check your portfolio. In a bull market, make sure that you have not gone down on quality. Check out whether you are too overly equity oriented. If you should be 50-50 and you're at say 80-20 thanks to the last 5, 6, 7 year bull run or whatever, then get to a more reasonable, will let you sleep at night kind of a portfolio. May not be the greatest time to be chasing returns, because returns have already come in the last 2-3 years, right? So right now move from return chasing to safety, right? You're just bringing down your scale. So maybe you should reduce your risk portfolio. Check out your job. How good is your job guarantee? Will you keep this job for next 2 years, 3 years, 5 years? Is your sector booming? If you are in a sector which is booming, you have good chance that even in case you were to lose your job, you will not have to worry. How good is your medical insurance? Because if you have a medical emergency in a bear market, you don't feel like selling your shares, and who will pay for it, right? So check up all that. Check up your, check up your bond, stock bond index, allocation. Check your job security. Check whether you have adequate insurance. Right, do these 3-4 checks. See if your job plan is going as per what you thought it will. See how your spouse is doing. See how your children are doing. If you are, say, 55, 60 years of age and your child is not doing well, you may have to sell something from your portfolio, right? Check up, keep checking on your investment quality. Check up on your spending. See whether you're spending too much or spending too less, or you're being frugal. Last 1 or 2 years has made us live very frugally, which is, I'm not even getting into good or bad. See how that is happening. See all that. Make sure that you have next, say, 5 years expenses or maybe 10 years expenses put away in debt funds, like ultra short bond fund or a short term income fund, or even better, a floating rate fund, or I think ICICI has an all seasons bond fund. Put into something like that and make sure that you take a 2-year view on that, but it's something which you can withdraw on a SWP basis in case you lose your job, in case your portfolio falls, any of those things. So preparing yourself properly, like changing your asset allocation, making sure that your job is good, making sure that the quality of your portfolio is good, making sure that your spending is in control, making sure that you have adequate money to spend for the next 3, 5, 7, 10 years, depending on the size of your portfolio. By doing all these things, you're preparing yourself well for a fall, because in case there is a fall, you have all these backup plans. Whereas if you don't prepare yourself for this fall, and when there is a fall and somebody like me comes and says, oh, stick to your asset allocation, equities are for the long run, it will sound like, Sala kya bol raha hai yaar tu, meri vaat lagi hai. But you can ensure that, like, your parents are adequately medically insured. If they are not medically insured and you can't get medical insurance, make sure that some 10 lakhs is lying in some fund for them, or 5 lakhs, depending on what you think. If your father is 65, it may not be so relevant, but if your father is 84, then it may be relevant that he may need some nursing care or things like that. So I don't know your real life situation, so I cannot give you advice, but I can broadly say, do all these things and you will be better prepared for a fall in the market. And in case the market falls, since you have good quality equity shares, these will bounce back. You don't have to worry. But if you have bad quality, then you're going to lose a lot more money, and those losses are going to be permanent. So you have to worry. If your portfolio is good, you have to worry about volatility. Whereas if you have a bad quality portfolio, you have to worry about crash. Those shares will just disappear. You will not be able to touch it, right? And there are many such examples, right? You take Suzlon, for example. It fluctuates from 3 rupees to 21 rupees and back to 3 rupees. It's irrelevant in your portfolio if it is bad, and it is irrelevant in your portfolio even if it is up, because how many shares will you pick up? You will pick up maybe 500 shares, 5,000 shares, 50,000 shares, not more than that, right? So don't lower the quality because the PE of good companies is high. If you think the PE is high, being in debt or debt instruments is not so bad an idea, but don't go low on quality. Just because interest rates are low, don't go low on quality of which company to keep your money. Sir, but he was giving 12% return. 12% is great, but 88% would be gone. Right? So find out, don't go down on quality. I'm saying this again and again and again and again. And please circulate this video. This video is more important than a video which says top 5 shares to buy. I can do that every day and be completely wrong and be completely useless for you. This video is far more useful than a video saying which are the best 5 shares to buy. Thank you.